Welcome to the Simply Safe Dividends channel. I'm Brian Bollinger. Finding high yield stocks you can actually trust isn't easy. Plenty of companies pay 5% or more today, but their balance sheets are stretched, their business models are shaky, or their dividends just have a history of cuts when times get tough. In this video, I'll walk you through the only 6 dividend-paying stocks in the market that meet a rare set of criteria. They yield over 5%, have investment-grade credit ratings, have paid safe dividends for at least 20 straight years, have a 5-year dividend growth rate of at least 3% to beat inflation, and they're trading near their 52-week lows, which can sometimes signal an overlooked business. Some of these names look appealing for income investors, while others might be cheap for a reason. We'll cover what's driving each stock's high yield, the risks worth watching, and where they might fit or not fit in a conservative dividend portfolio for retirement. I'll be using our website, Simply Safe Dividends, to find and research these ideas. I'll leave a link in the description below if you'd like to use our site to track your dividend portfolio and more. Our free trial is completely free. There's no credit card required or anything like that. I'll start here in our stock screener, where we have about 900 of America's most popular and highest yielding dividend stocks, and we'll start to input our criteria set. So we're looking for businesses that have paid safe dividends for at least 20 plus years. That drops down to 319 matches. We want these companies to have an investment grade credit rating of at least BBB- from S&P. Down to 226 matches now. We're requiring a 5-year dividend growth rate of at least 3% to again stay ahead of inflation, hopefully. Down to 187 matches. We want companies that are trading near their 52-week low, which drops us down to 41 matches, which is still impressive given this market has been red hot. A lot of these companies have not fared as well. And then last but not least, we will add a dividend yield filter requiring at least a 5% yield. And that gives us just 6 matches right now in the market. And we're going to go through each of these one by one, starting with the lowest yielder, Eastman, working our way all the way up to UPS. And I'll share my thoughts on each stock to give you my overall assessment of the company's dividend safety and long-term outlook, whether it could make sense for an income portfolio. First up is Eastman Chemical, ticker EMN, with a dividend yield of 5%. Eastman makes specialty materials you see every day, like the safety film inside car windshields, the clear layers that keep food fresh in packaging, fibers used in performance clothing, and protective materials that help paints and electronics last longer. Many of these products are patented, which gives Eastman an edge over basic chemical makers. Earlier this month, the company's share price had its largest ever one-day decline, falling around 20% in response to a weak earnings report and guidance cut. Eastman's stock now is at its lowest level in years and not too far above the depths it traded at during the pandemic. So the stock has been very beaten up, along with many of its chemical peers like Dow, really reflecting some challenges we've been seeing for several years now in the manufacturing space, which will pick up on demand from key markets like transportation, electronics, consumer durable goods. This chart here is showing an economic indicator that measures U.S. manufacturing activity. When it's below 50, that signals contraction. And you can see that's the state we've been in now for 3+ years. So while the stock market's been flying and red hot due to tech, a lot of these kind of old economy businesses are suffering as their customers are dealing with high inflation, high interest rates, and now the trade dispute, which is causing additional economic uncertainty. Now, falling volumes like Eastman has forecasted in the second half of this year are troublesome in a space like this that has lots of fixed costs. These are big manufacturing facilities, so when you run less product through, that really hurts profits quickly. Analysts are expecting a nearly 20% drop in Eastman's earnings per share in the year ahead. The good news is the dividend will still be covered by both profits and free cash flow, with expected payout ratios near 50% and almost 70%. Now, those numbers can and potentially will change a lot because demand visibility is so low, but there's still some nice margin there. And Eastman also has a strong balance sheet. If we come down to the net debt to EBITDA chart here, we can see that leverage was near its lowest level in a decade heading into this year. So that's allowed Eastman to absorb some of these hits without necessarily threatening its BBB investment grade credit rating, which sits 2 notches above junk. Overall, we are still comfortable giving Eastman a safe dividend safety score of 80. If you're unfamiliar with our scoring system, our scores range from 0 to 100, and we have a real-time track record since we started doing this in 2015. We've seen nearly 900 dividend cuts come through. We've posted each explanation for why the cut happened, along with the dividend safety score we had in advance of the cut, showing predictive value. The bottom line is investors who stuck with companies that scored above 60, so in our safe and very safe buckets, they would have avoided at least 97% of the cuts that have taken place. So right now, Eastman's dividend looks to be on solid ground like it has been for the 30 plus years the company has paid a safe dividend and increased it for 15 straight years, including a 2.5% raise last December. I would expect similar or maybe even a slightly slower rate of growth than that this year, just given that the demand environment has softened since then. But the company has a good dividend commitment, and shares could be pretty cheap right now. We can see here this blue band on the chart is showing you the price Eastman would trade at if the stock traded at its 5-year average dividend yield. Profits can be all over the place in a cyclical sector like this, but the dividend can be a more representative, stable factor of a company's long-term earnings power. And a lot of these mature blue chip companies like Eastman trade at persistent multiples over time, so that dividend yield tends to persist. And we can see the stock looked really cheap around the pandemic. It then recovered quickly during the era of high stimulus and overshot the expected value. And right now we're kind of in a place where it's pretty far below that expected price band of $90 to $110. So visibility is low. Things can always get worse in a space like this, but Eastman seems to have a solid financial foundation. It's still generating double-digit operating margins, showing the value of its specialty portfolio. And it's a critical player in a lot of end markets that should grow with GDP over time. Up next is Bristol Myers Squibb, ticker symbol BMY, with a 5.1% dividend yield. Bristol is one of the largest biopharma companies in the world with over $40 billion in annual sales. The company's stock price has sold off quite a bit over the last 6 months and now sits kind of near the low end of this trading range it's been in over the past decade, and well below the blue band, which shows where the stock would trade if it was near its 5-year average dividend yield. Bristol's yield has drifted higher from around 3% just a few years ago to north of 5% today, reflecting some uncertainty about the company's growth potential. Like most large pharma companies, Bristol has a good chunk of its revenue coming from what it calls its legacy portfolio. These are mature, older treatments, many of which have lost patent protection and are now declining. Legacy products are about half of Bristol's revenue and are declining around 15% this year, while the growth side of the business, medicines and treatments that are still ramping up towards their peak sales potential, are offsetting those revenue losses and helping Bristol's overall sales edge higher. But with any big pharma company, you should always look at the concentration of their portfolio in treatments and when those treatments expire. So in Bristol's case, it generates over 75% of its revenue from its 6 largest drugs, and all of them are either currently off patent or losing patent protection by 2028, including the blood thinner Eliquis, which is the biggest overhang on the stock. Now, several of these medicines are known as biologics, which, unlike a drug that's made through chemical reactions in a lab, biologics are made from living cells and organisms like bacteria, plants, and tissue. They're much harder to copy. So when they lose patent protection, they will see their sales shrink at a slower pace than something like Eliquis, which helps Bristol's overall profile a little bit, but these are still big headwinds to growth and make the company dependent on making acquisitions and partnerships and developing its own new treatments to offset those looming revenue losses. And the company has spent tens of billions of dollars doing that. It has an A credit rating, which gives it flexibility to make deals. The balance sheet is quite healthy. The net debt to EBITDA leverage ratio is near 2 times, which is pretty solid after all of its deal making the last couple of years. And the payout ratio also provides some flexibility here. This spike is due to some accounting noise from an acquisition, but the payout ratios are both kind of below 40%, looking at it from an earnings perspective and free cash flow. So Bristol has the ability to still retain pretty good cash flow to keep trying to strengthen its pipeline and protect its balance sheet. This conservatism has definitely helped Bristol pay safe dividends for over 50 straight years and grow its dividend for nearly 20 consecutive years. Growth was pretty slow last year, a 3.3% raise in December. That will probably continue until there's more confidence and clarity that these new treatments in the pipeline will ramp up as Bristol hopes and position the company well. Overall, I think the pharma space is kind of a tough one to invest in. There's a lot that's just outside of my circle of competence, being able to predict which drugs will do the best and become blockbusters is very hard. I would prefer a more diversified company like a Johnson & Johnson that also has a big medtech portfolio. But for a 5% yield, you're getting an A credit rating, a stock with pretty low expectations, selling recession-resistant products. So there is some to like about Bristol if you're comfortable with pharma, and also some of the regulatory and pricing concerns that have weighed on the space. Pembina Pipeline, ticker PBA, is our next company and offers a 5.5% dividend yield. Pembina is a large Canadian midstream services company with a big footprint in Western Canada, consisting mostly of oil and gas pipelines, storage facilities, processing plants, basically all of the infrastructure that energy producers need to move their commodities from the wellhead toward downstream markets. Pembina tries to serve as a one-stop shop for these customers by servicing pretty much every type of commodity and maintaining infrastructure across most steps of the value chain here. The business is fairly diversified. Natural gas liquids, crude oil, and natural gas each drive around 30 to 40% of Pembina's cash flow. Management also focuses on more resilient businesses. So around 70% of Pembina's cash flow is backed by take-or-pay contracts or cost of service agreements. So this protects Pembina if volumes were to drop or if energy prices dropped. This type of fee income remains much sturdier. Only around 10 to 20% of Pembina's cash flow is directly exposed to commodity prices. This conservative approach has helped Pembina generate steady cash flow and pay safe dividends for nearly 30 straight years. Dividend growth has been slower in recent years, around 3% per year on average, but I think there's a good chance that moves higher toward the back end of this decade. Pembina is embarking on a number of growth projects right now that take years to construct, but will start generating cash flow later and help improve the company's overall growth rate. Canada's starting to do things like export a lot more natural gas, which would bode well for a lot of Pembina's infrastructure. Now, the stock price has sold off a little bit since late 2024 when its price was looking a little overextended. A couple of factors behind this, none seem like serious concerns. That marketing arm of the business has been dealing with some unfavorable commodity price conditions, and then a couple of customers also reset their contracts at somewhat lower rates, which also weighed on sentiment and slowed near-term cash flow growth. But I don't think those issues really matter for Pembina's long-term outlook. The stock looks fairly reasonably valued today with a safe 5.5% yield. The payout ratio sits just under 60%. Pembina's leverage ratio is also near its lowest level in a decade, and that is supported by a BBB credit rating 2 notches above junk status. Now, Pembina is not an MLP. You will receive a 1099 form if you own this stock, but it is a Canadian company. So if you're a U.S. investor, just be aware that there is a 15% withholding tax, but the taxes will not be withheld on dividends if you own Pembina in retirement accounts like an IRA. So if you kind of believe in Canada's future as a natural gas exporter and a lot of the infrastructure that's being laid there, that would benefit Pembina. I think fossil fuels are likely to be around a very long time, so this should stay a cash cow business with a good yield and low to moderate income growth. Edison International, ticker EIX, offers investors a 6% yield and is a regulated utility serving California. Now, utilities are usually thought to be defensive investments, but California utilities can be a bit of a different breed. EIX shares fell nearly 30% back in January this year when the Eaton wildfire broke out. This is one of the most deadly wildfires in state history, and there's thoughts and speculation that Edison International's electrical equipment was responsible for causing this blaze, which again will be one of the most costly events ever for California. And EIX points to the state-run wildfire fund that was set up in 2019 to help protect utilities from exactly this type of event. The fund holds roughly $20 billion that can be reimbursed to EIX for the claims it will pay for this wildfire if it is found to be liable and acted responsibly with trying to, get its gear shut off in a reasonable amount of time, all those things. If the utility is found to have not acted responsibly, the utility shareholders could be on the hook for roughly $4 billion or more of these claims. And there's some concern that this fire's total damages will exceed the roughly $20 billion that reside in the wildfire fund. And in either of those outcomes, where the utility acted imprudently or there's just not enough funds available, then EIX would need to stretch its balance sheet a bit, and that could cause some problems. The utility has a BBB credit rating, but a negative outlook. If the balance sheet did get stressed, management could look to conserve cash by cutting or suspending the dividend. We give EIX a dividend safety score of 50 while it kind of navigates these issues. Shares look very cheap for this reason. They trade at 9 times forward earnings compared to 19 times for the utility sector. That discount may prove to be a little extreme, but I think a company like this will always trade at a discount just because it does have that wildfire risk constantly hanging over it. And the Eaton wildfire issue will probably take several years to resolve, so there may not be a very quick fix. For me, as a conservative investor, this type of company doesn't really interest me. I have really no insights into what will play out with the Eaton fire situation. You kind of would have to believe that California is serious about protecting these utility companies and their investors, and that the billions of dollars that EIX is spending to help reduce risk of starting future wildfires will be effective and start to change the narrative around this company. I'd rather stick to more proven utilities that have greater visibility into both their dividends staying safe and growing at kind of a healthy mid-single-digit clip in the long run. Flowers Foods, ticker FLO, sports a 6.3% dividend yield and is one of the largest bakeries in the U.S. with a leading portfolio of bread brands, including Nature's Own, Dave's Killer, which is the #1 organic bread in the country, Canyon Bakehouse, the leader in gluten-free bread. Flowers also made a large acquisition of Simple Mills earlier this year to gain a foothold in better-for-you snacking products like crackers and cookies. It also has some smaller brands like Wonder Bread, Tasty Cake snack cakes, and a handful of others. Now, bread has always been a cash cow business. It's bought by virtually every household in almost any economic environment. In fact, during the 2008 financial crisis, Flowers sales were down less than 3%, and the stock was almost flat while the S&P 500 lost 55%. But Flowers has not been a defensive stock at all since late 2022. Its share price is down nearly 50%, reflecting some major headwinds and uncertainties with its core category. This chart here is showing Flowers' fresh packaged bread volume change in gold and dollar change in blue over the last 8 quarters. You can see there's been a big deceleration with both measures off around 3% in Q2 of 2025. That reflects both consumers trading down to private label goods and just a more intense promotional environment. But there's a lot of concern that this core loaf business may never be the same as Americans kind of pull back on ultra-processed foods, GLP-1 adoption rises. And what's tough for Flowers right now, and reflecting the high yield, is the company doesn't have a whole lot of financial flexibility to potentially adapt its portfolio if this is kind of the new normal and all these bakeries are fighting to keep volume. Flowers' payout ratio is expected to breach 90% over the next 12 months, and if you believe analyst earnings estimates beyond that, it's expected to stay near that level for several years. Free cash flow, the dividend is still covered, but it's uncomfortable, expected to be over 80% in the year ahead. And with that Simple Mills acquisition, which cost roughly $800 million, Flowers' leverage ratio has ticked up just above 3 times. That's kind of near the highest level it's been in a decade. So the balance sheet doesn't have a whole lot of flexibility to make another deal to evolve the portfolio faster. So the concern here is that if bread stays weak and this intense competitive environment worsens further, then Flowers could have limited ability to kind of navigate this environment because its high payout ratio prevents paying down debt and its elevated leverage prevents doing more deals to kind of evolve its business mix. And that could spell trouble for the dividend potentially. Now, the company has paid safe dividends for over 20 years and grown that dividend every year, including a 3% raise this May, which expresses some confidence in the company's cash flow and outlook. I think if things do keep getting worse, the dividend faces a lot more pressure over the next year or two. We give the company a borderline safe dividend safety score of 50. Overall, I'd prefer to own a business that has clearer paths to long-term growth and greater financial flexibility. Right now, Flowers doesn't have much of a margin of safety, so it feels riskier to me than some of its peers. United Parcel Service, or UPS, has the highest dividend yield on our list with a 7.4% payout. The package delivery giant has been around since 1907 and is one of America's oldest and most iconic businesses. For many decades, UPS and FedEx enjoyed a duopoly position in the market thanks to their massive integrated air and ground networks. UPS has over 100,000 delivery vehicles in addition to over 500 aircraft that it uses to move over 22 million packages and documents on average each day of the year. Very hard to compete with this business because it can spread the costs of its capital-intensive network over all these packages to offer both cost-effective service and plenty of convenient locations to both pick up and receive goods. Now, I've owned shares of UPS since March of 2018, about here on the chart. I'm up slightly with dividends, but this has been a pretty disappointing investment overall. You can see during the pandemic, UPS's stock boomed along with its earnings, but since then it's been pretty ugly and kind of revealed some of the big challenges and change that's taken place over the past decade. Now, this article did a pretty good job of summarizing those changes. If you roll back the clock to 1998, FedEx and UPS had collective market share of about 90%. Today, less than 50%. Now, of course, Amazon is one we can talk about. They've done an amazing job growing their own logistics network over the last decade. UPS is moving away from Amazon, which was 12% of their sales last year, albeit with low margins. But another big part of the story is these other big retail giants like Walmart, Target, Staples. They've realized that their store footprint is a huge strength with online orders. So they've been able to fulfill them from those stores instead of relying as much on FedEx and UPS. They can use gig workers, contractors, regional carriers, and that has kind of broken my thesis on UPS, which was really that a rising e-commerce tide would lift all boats, even with more competition. Instead, UPS is now moving away from low-margin e-commerce and trying to replace it with higher-margin demand from delivering healthcare products and working more with small and medium-sized businesses. Now, income investors are sweating this one a little bit, and that's in part because, in large part really, UPS decided to hike its dividend by 50% during the pandemic. So the payout's been paid safely for over 50 years, but this dividend hike was probably unprecedented going back for decades. I haven't looked, but it was really in response to this big boom in demand as everybody was at home and shopping online. This is some of the research we published. Part of our service is keeping a close eye on the safety of each company's dividend and publishing research to keep shareholders informed. But we put together this chart showing UPS's annual package volumes going back to 2008. And you can see they just exploded during the pandemic here in 2020, 2021 when the dividend was hiked. But they've since been coming down as parts of the economy have slowed, competition has moved higher, and now UPS is trying to kind of scramble away from those lower margin e-commerce deliveries that have more competition. The problem is UPS has this unionized labor force and also, this kind of rigid network that's been in place for decades. So change is hard and costly, and UPS is kind of in a race against the clock. The company's payout ratios are stretched. Free cash flows expected to still cover the dividend next year, but that 90% payout ratio is well above management's 50% target. The saving grace really, I think, for UPS right now that gives it some time is the balance sheet. So net debt to EBITDA, the leverage ratio, has stayed pretty low despite these big hits to earnings and cash flow. The company does still maintain an A credit rating. And that gave management confidence last quarter to say that UPS is rock solid strong, which is debatable, but so is our dividend. It's backed by solid free cash flow, a strong investment grade balance sheet. We know how important the dividend is to our investors. So they've given a pretty strong commitment. I mean, we've seen this in the past with other companies like Walgreens that talked a big game and then reversed course less than a year later. So you can't put too much weight on it. But for now, I'm not thrilled to be a UPS shareholder still. This is probably a company I'll eventually look to move on from. Expectations seem low. I think there's still a need for UPS, but can it pivot into healthcare and more B2B business in time while it winds down Amazon? That's the big question to watch. I hope you enjoyed this video and maybe even walked away with a few ideas for further research, or at least learned some practical pointers on how to really dig into dividend stocks you're considering for your own portfolio. If you are an income investor and looking for new tools and research to help your portfolio out, I'll shamelessly plug our service, Simply Safe Dividends, one more time. We publish research throughout each week to again help you kind of stay informed on what's going on and make sure your dividends stay safe. We also have a robust portfolio tracker that does everything from keeping tabs on dividend safety of your portfolio, making sure you're reasonably diversified, a fully customizable holdings table with dozens of different metrics you can choose from, email alerts whenever companies change their dividends or we publish research on them. It's all there and completely free to try. You have 2 weeks, no credit card required or anything like that. So I'll leave a link again in the description below. Thank you again for watching, and I hope to catch you next time.